afternoon, everyone. Thank you for joining us on this extremely cold day. If you're in Chicago, I'll introduce my teammate and partner, Tom Briney, in a moment, but Tom flew in from Denver, and I can assure you it's colder here than Denver, probably than the mountains of Denver even. We're here to talk today about the Multifamily Credit Fund. This is something we've been working on for over 20 months. We launched the fund in September. But truthfully, we've been active acquiring these Freddie Mac bonds since January of 2021. And so we have a lot of activity to share. The way we're going to present is for the first 30 minutes, we'll talk a little bit about Origin and a little bit about the fund. It's important that you, as potential investment partners, understand the risk return of the product, but also how the returns are derived, what the Freddie Mac bond is, why it exists, and why it's such a difficult market to operate in as a partner to Freddie Mac, which Origin has been working very hard to become for the past 20 months. In a moment, we'll start the slides and I'll tell you a little bit about Origin. Just a couple things, a really large group on this webinar today, so thank you for your interest. We will do Q&A for a full 30 minutes. And so, first of all, many of you sent in questions, and thank you for that. We're going to try to answer those organically through the presentation. If they weren't answered, just go to the Q&A box and ask your question again. We're committed to transparency at Origin and all of our funds, and so we want to make sure every question is answered. The other thing I want to share is, even at the end, if you feel like you still weren't answered or weren't answered to your full expectation, you don't have clarity, please reach out to myself or Tom. My email and cell phone is on the website, always available. We believe that educated investment partners are the best investment partners, so we want to do that. Okay, so with that, a little bit about myself. I'm the co-founder and co-CEO of Origin Investments. That means I've been doing this for about 14 years. Don't want to date myself. Had a career prior to that, which, interesting enough, intersects pretty well with this strategy, being that it's in credit. I traded credit derivatives for 10 years prior, and that's what actually brought me to Chicago. And then I transitioned into real estate private equity around 2004. Let's get the slide started. I think a lot of people on this webinar are existing clients, and thank you for considering another fund investment with Origin. But there's also a lot that aren't. So I do want to spend a little bit of time describing Origin and why it matters. First and foremost, we're 100% focused on multifamily, and that means apartments that are rented. I figured that out recently. I was on a call with a group in the Middle East, and I said multifamily a few times, and then they finally said, we don't know what multifamily is. And I said, okay, it's apartments, it's rentals. But we build, operate multifamily throughout Texas, the Southeast, the Southwest. We're based in Chicago. We have 38 team members, and it's really across the board. Some of those team members are in Chicago. That's our operational hub. That's where I am. It's actually where Tom is today. All of our analysts are here. We have 8 analysts, and then also all of our back office. So our investor relations, our marketing, our accounting, our legal, and our data scientists are here. But then we have regional hub offices, and Tom is actually the head of our Western regional office and activities, and he lives and works in Denver and covers the West. We don't cover the coast, so if you're interested in this strategy, we cover everything, because Freddie Mac sources across the country, every market. But traditionally, we're an equity real estate manager. And in those investments, we only are in the Southeast, Texas, and the Southwest. We have 9,000 units. We have an additional 3,000 units that are under development. We're one of the more active multifamily or apartment developers, certainly in our regions. Again, the Southwest Texas, the Southeast. Some of the things that we're super proud of, probably the biggest is top decile fund manager. We were awarded that designation this year by Preqin, which is a manager rating firm. And what I'm proud of there is it's all of our work. This goes across all 6 of our funds, and it speaks to the consistency of our outperformance. We actually are a top 2% manager. We say top decile because we want to make sure that we're always, these things can change, and we want to make sure we have a lot of margin for error in top decile when we're top 2% now. So how did we do that? A 2.1 average equity multiple, that's what we're really after. That means if you invest $1 million with Origin, your return 2.1 million. $1 million, of course, is the return of your capital, but the $1.1 million is your gain on that investment. That equates to a 24% average gross IRR. Again, what I'm really proud of is the 0 realized losses. We've done an awful lot of investing over the last 14 years, and we've never had a loss. And that speaks to our operations, our ability to find and select the right deals with the best expected values. In terms of a huge differentiator here is the management team, myself, my co-CEO, Michael Episcope, but also Tom Briney, Dave Welk, others that I'll introduce. We invest significantly alongside our investment partners. So it's really important as an investor to know that your management team is fully committed and behind what they're doing, and 60 million across what we've done. We're 1.4 billion of assets under management. That's a lot of alignment, and so I think that's something that I'm spending a little bit of time on. But I would just encourage everyone to, whenever you're thinking about investing, to make sure that you ask these types of questions of the management team across any strategy, venture, private equity, real estate. Next slide, please. So I'm going to speak a little bit about the fund benefits, then I'm going to introduce Tom. But this is specifically to the Multifamily Credit Fund. The Multifamily Credit Fund is our lowest risk strategy that we have at Origin. Most of our strategies are equity strategies. That also means that you're in the first loss position. The difference here is you have, on average, 30% or more equity ahead of you as first loss. So when you're talking about 6 to 8% annual yields that are actually paid monthly, so you would divide that by 12, obviously, it's significant amounts of yield with a tremendous amount of protection. In this fund, that equates to a 1.6 net multiple. And so when I say net, it means after fees, after promote. This is what comes back to you: 6 to 8% target net annual yield, 1.6 target multiple. Net equates to an 8 to 10% net IRR due to you, the investor. So the downside protection I spoke of a little bit, but there's more to it than just the protection in the capital structure with the 30% equity ahead of you. And Tom will address this in more detail, but multifamily, to start with, is all of the collateral in the bonds that we're buying. And so not only is that the only thing that we do at Origin, that's all we invest in, so we know it quite well, but it also has been the lowest volatility or risk real estate asset class for the last 30 years. And that's very intuitive if you think about it. When there's a recession, people can cut down their discretionary spending. They don't go out to eat. They might not take a business trip or a leisure trip, but they do pay their rent. They need somewhere to live. So this is a necessity item. And again, in the business cycle, when we hit a recession, that's proven true. COVID was another example of that. When COVID hit, people were worried about apartment renters paying their rent, and that simply didn't happen. People paid their rent. The other benefit of the fund is monthly income, and I touched on that, but there's a 6 to 8% net annual yield to you. Everyone on this call knows that interest rates are really, really low, and it's hard to get your money to work for you, but also feel good about it. Not stress out because the stock market was, down because of whatever reason that day. This is a bucket of capital that you don't stress out over. You do get yield. I'm investing significantly into this fund for that reason. At this point, I've committed 4 million, but I'll increase it. A built-in hedge against inflation, and this addresses quite a few. We probably had 30 questions, and I would say 4 of the questions, 4 or 5, were some iteration of this question. So the bonds that we're buying, they're both current pay bonds and accrual bonds. And in our portfolio, will be weighted more heavily to current pay. Why am I saying this? Because the current pay bonds are priced over LIBOR, and LIBOR is the rate that's very much affected by Federal Reserve tightening or easing. So right now, LIBOR sits at essentially 0 because the Fed wants a lot of liquidity. If they started tightening, LIBOR would go up, but the bonds that we're buying are priced as a spread over LIBOR. So I'll take you through an example. Right now, we're buying bonds at 700 to 850 over LIBOR, but LIBOR is 0. To complicate this a little bit more, LIBOR is now SOFR. So if you hear SOFR later in the presentation, it's very similar, but there has been a change there. But if they start tightening, then it's no longer 0. It might be 1% or 2% or 3%. But if we had a 700 over LIBOR or SOFR bond, and LIBOR went to 3, now you have a 10%, not a 7, because it's priced, it's the LIBOR rate plus the spread. So long-winded way of saying there's an awful lot of inflation protection within the bonds themselves. And that's something that's very interesting about this strategy. So I'm going to actually turn it over to Tom Briney. I mentioned that he flew in from Denver. He's literally right across the hallway from me here in our office. Tom joined Origin from equity office, Blackstone. Essentially, Blackstone acquired a large portfolio at equity office, and then Tom worked with Blackstone for about 5 years. He came to Origin in 2011. I believe he just had his 10-year anniversary here. So Tom's been prolific in deal sourcing in the Southeast and now the Southwest. He's unbelievably quantitative and the right person, because this is we'll make this sound simple. And it's a simple logic behind the strategy, but it's actually quite complex in the pricing and the modeling. So without further ado, I'll introduce Tom, and then we'll circle back and I'll address some of the fund fees later. Tom?
Thanks, Dave. Appreciate it. It's good to be here in Chicago, and I think cold is an understatement. I know it's not January cold, but compared to Denver, it's brisk. So it's good to be here now, and I'll be looking forward to heading back to Denver, where it's nice and balmy warm later this week. We were talking earlier about this. This is a bond or a fund we've been working on for the better part of 2 years at this point. And it really started as COVID was just starting to pick up, and we were trying to explore other opportunities for investment, because the most critical piece to investing in real estate is to always be active. When the market gives you something that seems like an outsized return for the risk that you feel like you're taking, you want to jump on it. And that's one thing that Origin, in my decade plus here, has done really well, is move to where the market is giving them opportunities. When I found this opportunity, I brought it to Dave again in Q1 of 2020 as COVID was getting going. He immediately recognized the value that was being presented through this investment structure. And what's really unique about it is, I mentioned that you've got to be malleable as a fund manager. What's interesting about this is an enduring edge for the duration of, it's been going on for 27 years. We've discovered it. I believe it'll be going on for another 27, 50, 100 years from now. It is an enduring edge, and it's taken a long time to get into and to really understand the workings of it. But it's something that should be around and available to invest in and to benefit from as investors for the foreseeable future. So let's talk about what that is, Jeff. Let's start the slides. So what is a Freddie Mac B-piece? So Freddie Mac, for those of you who might not be familiar, they originate anywhere from 70 to $80 billion a year of new multifamily loan production throughout the United States. So every single year they have a sourcing army out there that brings in high quality cash flowing assets from around the country that are then put into these larger pools. And that's that Freddie Mac multifamily box at the top. Each pool consists of anywhere from 40 to 60 loans collateralized by cash flowing multifamily properties. And the pool total is about 800 to $1.5 billion. Some are larger, some are smaller. And then Freddie Mac tranches them up. And the idea behind this is that the A piece represents anywhere from 92 to 95% of the larger tranche above. And those A pieces are federally guaranteed. The payments of principal and interest are federally guaranteed to the buyer of that A piece. That means the yield on those A pieces are similar to the yields that you would get on a corresponding treasury. So today, a 10-year treasury is 1.5%. That A piece will trade 15 to 20 basis points above that corresponding treasury. Why? Because it's the same risk profile as the US government. We're focused exclusively on the B pieces. So the B pieces, that blue box on the right, they are non-guaranteed by the federal government. So we are taking a position that is at risk, if you will. And rather than getting paid the corresponding treasury plus 10 basis points or 20 basis points, we're getting 7 or 8%. So 700 to 800 basis points. Substantially more yield and total return than the A piece. And it only represents about between 5 and 7.5% of the $800 to $1.5 billion bond. But you're in a first loss position from the debt piece. And I'll explain what that means in a minute. So these B pieces then have several different subtypes that you can be invested in. The floating and the fixed, which are what Dave mentioned earlier. So you have floating rate K-deal B pieces on the bottom left there. That means that the underlying loans from the underlying apartment complexes that make up the pool are all floating rate loans. So as interest rates go up, then the rate that the borrower pays goes up. When the interest rates go down, the rate that the borrower pays goes down. And this is the inflation hedge that Dave mentioned, and this will make up these floating rate B pieces, will make up a majority of the fund collateral, the fund investment. The next most prevalent piece is the Freddie Mac B-piece that are fixed. The fixed is exactly what it sounds like. The underlying collateral has a fixed rate debt, like most of your mortgages. They'll have you have a set principal and interest every month. You make that payment, and it doesn't vacillate based on what's going on in the capital markets. Those two pieces will make up about 70% of the fund collateral. And the last two pieces are SBL, which is small balance loans, and interest-only strips. These are higher yielding, higher total return investments. They have a little bit more risk because the SBL, the small balance loans, they are collateralized by smaller, less institutional properties. And the interest-only strips are just smaller in general, and so have a little bit less prevalence within the fund makeup. Let's move on to the next slide, Jeff. So I mentioned earlier that although we are in the first loss position, as you can see on the right here, this B piece, we are in the first loss position of the senior loan. However, there is more than 30% cushion ahead of us from the borrowing entity. So to back up to what we are actually talking about here, a group like Origin or Blackstone or Carlyle or JP Morgan will buy a property and they'll put 30% cash down on that property. Then the rest, the 70%, which is the senior loan plus the B piece, is their individual loan. All Freddie Mac is doing is taking that single loan and splitting it into two pieces. And so they're splitting it into an A and a B, which you can see here, and we're buying the B pieces. So in order for our capital to become at risk, all of the borrower equity cushion, that's 70 to 100% or 30% of the total value of the property, has to be eliminated. And at that time, if it is eliminated, then it starts to eat into the B piece. And the B piece is expected to protect the A piece. And if for some reason the B piece is eliminated entirely, then the A piece would be federally guaranteed. However, that's never actually happened. Over the 27-year history of this program, there hasn't been a situation where the B piece is wiped out entirely. It just doesn't happen. because there's so much cushion from the borrower equity cushion here. And those borrowers are institutional in nature. They're the Origins, they're the Blackstones, they're the JP Morgans. They won't allow their property to be wiped out, because if they give a property back to Freddie Mac or Fannie Mae, they won't be invited to borrow from them ever again. And the loan rather, is such a advantageous piece of investment for those groups that they won't allow their loans to go sideways. So let's go on to the next slide, Jeff. And as you can see here, the historical loan performance speaks to exactly what I was talking about. This is the summary of the last 27 years of origination and loss throughout the entire Freddie Mac program. And you can see in 1994 it was a small program at $500 million. And in 2020, they originated about $60 billion. In total, over the last 27 years, they've originated just under $600 billion of loans, and they've recognized about $240 million worth of losses, 0.07%. So less than 0.1% loss over a 27-year history. That is the lowest risk profile that I've seen in multifamily investing in my 15 years doing it. What's also interesting is looking at the 2006 vintage. So that is the worst vintage year. Now this chart is broken out by vintage year. So 2006, which is highlighted at 0.4%, those are the loans that were originated in 2006 and recognized loss at some point down the road, likely in 2009 and 10, as the great financial crisis was coming into full swing. So the losses recognized in 06 of $50 million worth of losses on just shy of 11.5 billion of origination equals about 0.4% of loss in what is largely considered one of the greatest economic crises in the last, really since the Great Recession. And so when you've got that level of equity protection, you've got that quality of institutional borrower, you can see that the risk of capital loss is extraordinarily low. And we ran a scenario where we said, what happens if we built an entire fund focused exclusively on buying bonds in 2006? If we bought all of our cash with a single vintage bond that happened to be the worst vintage in the history of the program, what would happen? And the long story short is the investors would generate about a 7% total return. That's a function of buying it, having the cash flow occur during some period of time prior to the crisis, losing a portion of that, call it 50 million out of 11 billion, and then continue to cash flow the remaining assets. Because it's important to note that although you lost $50 million in that year, you still had 99.5% of your total investment intact. And so the total return, even in the worst case scenario, is still an extraordinarily outsized return for the risk that's being taken. Let's go to the next slide. So how are these bonds available? Why are the returns so good and the risk so low? And this is where I started talking at the beginning. It's extraordinarily hard to get into this ecosystem. Freddie Mac has said, we want to know if things go wrong, that we have a partner in hand that can help us work through those issues. And as that, they look at these 4 criteria to make sure and underwrite the buyer of these B pieces for a good 18 months. And these 4 criteria, the first is operational experience. They want to know that if things go sideways and you have to take over a sour loan, that you know how to operate that property and protect that loan as collateral. Origin has, we noted in here, 9,000 apartment units currently under ownership. Over time, we've had more than 14,000 units. We've got a strong regional and national operating platform with 4 offices across the country, plus here in Chicago. And Freddie Mac is very satisfied with our operational expertise. It's also worth noting that Funds 1 and Fund 2 of Origin, plus pre-Origin traditional funds, a lot of the work we were doing were buying loans out of bankruptcy, doing deed in lieu of foreclosure, and a lot of different work that would result from a stress situation like a 2006 scenario. So Freddie Mac's gotten a tremendous amount of comfort from us that we know what we're doing in operations. Secondly, they look at Origin as a borrower of Freddie Mac. It's important to them that we understand the loans as collateral. Origin, when we buy our private real estate, as Dave mentioned earlier, in our 10,000 units, we use Freddie Mac as a loan. We understand the loan documents intimately. We're closing on another Freddie Mac loan assumption here at the end of this month. We are an active participant in the Freddie Mac program, and that's very important to them, so that we are a partner, not just a buyer of the bonds, but a true partner of theirs throughout time. The third piece is a significant capital base. And the way the program is set up, this is a very capital intensive program. Every time you buy another bond, you're looking at between $20 and $60 million of equity that needs to go out the door. And the expectation from Freddie Mac is that you consistently have the ability to close on the next bond, whenever that might occur. Sometimes that's 1 bond a year, sometimes that's 8 bonds a year through them. And then on top of that, there's opportunities in the secondary market, which we can touch on in a bit, to continue to buy their product. And they want to make sure that you have the ability to execute when it's time to execute. And that's why we have raised the fund and continue to raise the fund. And we're looking for partners who will continue to invest with us in this program over the long term, because there will always be a need to invest at these yields and better. And the final piece is they want to make sure that you're a long-term holder. One of the benefits of buying in the primary rotation, which Origin is, there are only about 15 or so firms in the world who have been approved to buy Freddie Mac B-pieces directly from Freddie Mac. Origin is one of those 15 groups. They want to know that Origin is going to hold the loan long term, because there's an edge. As soon as you acquire that bond, so let's say you buy, as Dave was saying earlier, L plus 600. We acquire for L plus 600. We could turn around in the secondary market and sell it tomorrow at L plus 500 and generate that 18% benefit day one. So why not do that? Well, Freddie Mac has spent so much time digging into us and understanding who we are and making sure that we're a good partner. And if things go wrong, they want to know that we're there as their partner. If we start selling these loans on the secondary market the day after we buy them, they would see us not as a partner, but as a buyer and flipper of their product. That's not who they're looking for. That's not why they spend the time to underwrite us and to dig into all of our operations. They want to know that we're there long term. Now, long term is nebulous, right? So is long term 6 months or is it 10 years? That is open for discussion. And as long as you're not flipping product the next day or the next month, Freddie Mac is okay with that. But it's important to note that there is a very healthy secondary market for these B pieces. We can reach out to JP Morgan or Amherst or Wells or B of A and sell one of these bonds tomorrow, right? And create liquidity within the fund. And I think Dave will talk about the liquidity in a little bit. We can also buy on the secondary market. Now, again, this is only works if you're a good partner to Freddie Mac. And so we're very sure to make sure although we've checked the boxes for all 4 of these components, we need to make sure that we're continuing to do that over time. That's everything that we've talked about here. Jeff, go on to the next slide. So we acquired this fund seed deal back in January of this year. This is part of the fund. This is if you choose to invest in the fund, one of the assets that you'll have as your collateral, as your investment. There are 5 or 6 additional IO strips now, and I'll talk about the pipeline in a minute, but there are several more that we know about. But as a high level, let's talk about the KF96 investment that we made back in January. At origination, there are 49 loans total in this bond pool. So that larger bond pool that I showed at the very beginning, there are 49 loans, and the total bond size here is about $1.1 billion. Of that, the B piece was about 84 million total, and Origin has invested 25 million of that required equity. So we have 25% ownership in this bond piece. And the bond itself, the underlying collateral of the bond itself, as you can see, the loan to value at origination was about 72%. So we had about 33% common equity cushion ahead of us. Now, what's unique about that and important to note is, of the loans and the underlying collateral, about 80% of them were going to execute some form of value add, meaning they were going to add additional cash collateral to the properties in order to make the property better, to increase the rents, to increase the NOIs. And so although the loan to value at origination was 72%, when you include the cash, the additional cash that was going to be spent on those upgrades, the loan to value is actually closer to 61%. And then you take into consideration the value that is created by spending money, the value of the property increases. This bond is closer to about 55% collateral or loan to value today. So it's in just a short 11 months, it's become extremely protected from an equity position. Our investment is extremely protected and becomes more protected every single day. But what's unique about it is our yield hasn't changed. So we bought this at LIBOR plus 860 basis points, so a very wide spread relative to where they are today. And as the collateral becomes more and more protected, meaning our position within the bond becomes more and more protected, our yield stays the same. So the probability of any losses occurring in this bond have gone as close to zero as they can be over this short period of time, yet the yield remains the same. And when we look at a bond like this, there are a couple of different things that we look at. The first is the geography. If you recall, in the start of COVID, really through all of 2020, there was a lot of concern on the coast. As Dave mentioned earlier, our private investments are not on the coast. But a lot of the bonds, because Freddie Mac originates nationwide, do have coastal exposure. So the first thing we look at with these bonds is where are they located geographically. And one thing that got me really excited about this bond when the opportunity presented itself was that it doesn't have New York or California exposure. And if you think about when these were originated at the end of 2020, nobody wanted exposure to the coast. So this really fit our bill very well, and that it's in the markets that we invest in anyway. If you look at the four of the top 5 geographies, Arizona we own, Georgia we own, Florida we own, Texas we own, and a private real estate perspective. And so we know these assets, we know the geographies, we know the collateral, and we know they're very, very well protected. The second piece of the bond that I look into is the composition of the bonds. This one is 98% multifamily. You can also have student housing, you can have manufactured housing, as well as senior living. And this one doesn't have any student housing. Again, when it was originated, student housing wasn't a viable investment opportunity, so there wasn't a whole lot of that trading. But the idea that this has 98% multifamily makes an extraordinarily strong bond. Now, bonds can comprise up to 15% non-multifamily loans, so being manufactured, senior, and student. They generally will not exceed 15% other, so minimum 85% multifamily, or in this case, almost 100% multifamily. That is a traditional range that should be expected. This is indicative of the type of bond we'll be buying going forward. And we have 2 more bonds that will close in the next, we'll call it 90 to 120 days, that look very similar to this. Jeff, can you go to the next slide? This is our deal flow slide. This represents a $250 million fund and the allocations of what we have today versus what's still available. So as I noted on the prior slide, that KF96 is a 10-year floating rate bond. We also have a 7-year fixed rate bond that will be closing next month. That makes up part of that 7.4% allocation. And then later in March, maybe early April, we'll get an additional floating rate bond that'll bring us to 32% floating. And of those bonds that I've mentioned, plus the KF96, 42% of the $250 million fund is already accounted for. This is not a blind fund or a blind pool anymore. Investors in this pool know exactly what they're going to get for the first half of the bond. And the second half of the bond, that 52% of available for investment, that is going to be more of the same. It's going to be more fixed, more floating, some IO, and potentially an SBL piece. And Jeff, go to the next slide. This is our fund composition. So the target portfolio allocation here is that blend of fixed, floating, IO, and SBL that I've mentioned. Now, these percentages are a target allocation, not a guaranteed allocation. Our objective will be to have more floating than fixed, and that's highly probable that will be the case. And because it's got a very strong yield and it is inflation protected, as Dave noted, but there are no guarantees that these percentages will work out exactly in this manner. This is a target allocation. I think you should expect as an investor plus or minus 5 to 10% in either direction. But I will tell you that the majority of this fund will be fixed and floating rate bonds. I'm going to flip back over now to Dave to talk about tax structure.
Thanks, Tom. Awesome. Thank you, Jeff. If anyone in this fund is in our Income Plus fund, you'll know that we have a subsidiary REIT in that fund as well. And the reason for that is the 2017 tax reduction bill enacted. If you have income that flows through a REIT, it reduces the dividends, the dividend taxes by 20%. And so our Income Plus fund has had that for the last 2 years. The reason I'm mentioning that is Origin is experienced at setting up a REIT, complying with a REIT, and having those benefits flow to our investors. We didn't touch on this before, but on the capital raising side, not just for this fund, but all of our products, all of our investment partners to date are taxed investors. And so we currently have over 2,000 investment partners. We have over 40 registered investment advisory partner firms, and all of their clients are taxed. I mentioned before that Origin has a lot of co-investment. We invest a lot in our own products. Obviously, myself, my partner Tom, our senior leadership team, they're also tax investors. So we share not just that we want to have great risk-adjusted returns, but what we really want are great post-tax risk-adjusted returns. And so one of the benefits of this fund is with the subsidiary REIT structure, virtually 80% of this return is via dividends. It's current pay. And so those will be reduced by 20%, those dividend payments, because we have a subsidiary REIT structure. I don't think, well, a couple things. It's really hard, and back to sort of the mission of Origin, we want to bring institutional investment opportunities to people like me and you and Tom. And so often when I'm talking to people, successful people, they say, look, I'm doing well, but I don't really feel like I have this great menu of investment options that are maybe available to the large pension or the large endowment or the large family office. And by the way, we have plenty of family office clients too. I don't have anything but good things to say about those clients or family offices. But my point is, when you have $1 million to invest, or 500,000 or 200,000, it seems like the universe of what's available to you shrinks so much. And our mission is to actually have that available to you, because we think that it's important. That's really what we're doing here at Origin. That's why we have 2,000 clients. And that's also why we've had to become a pretty big company, because it takes a lot of people to give those people the risk-adjusted returns. That's the acquiring at the right price and the right expected value, to developing the business plans, delivering them, to the service side, right? So making sure you get K-1s on time for your own taxes, making sure you get good reporting, making sure that you always have your questions answered. It takes people to do that, but we've proven that we're able and willing to invest in all of those processes to do it. Subsidiary REIT is just another example. Next slide, please. So the summary of terms, this is the terms of the fund. Tom mentioned some of the benefits. One of the benefits of the fund is K96, the bond that he took you through as an example of our underwriting and how we look at and approach these bonds and the loans inside of them. K96 is also 20 to 30% in the money. In other words, when we buy something at an 8.60 over LIBOR yield, and currently it's trading at 5 to 5.5, we're not going to sell that bond. Back to Tom's point, Freddie Mac's our partner, and we're not going to do that. But if we did want to do it, it's 20 to 30% in the money on a $25 million investment. So I know everyone can do the math who's on this call, but it's deeply in the money. What we'll do instead is get an outsized yield paid monthly, and that's a 10-year floating rate bond payable monthly. We don't mark up that bond. If you invest in the fund, you get it at our basis. That's true of the September 2021 fund investors as well. That's not something we'll do. The IO strips that we've been buying that Tom mentioned, each time we buy something in the primary, we're getting an 8 to 10% edge, because that's what approved primary buyers get. That's what excites me the most about this product. It's really hard to get approved. As Tom mentioned, there's 15 buyers currently in the world. And by the way, that's also why it's the highest return relative to risk that I've seen in credit. And back to just logic. Of course it is, because there's so few buyers. if you see value in a corporate bond or a government sovereign bond, just go buy it. Anyone can buy it. And that's what drives yields down. Here, there's just not a lot of buyers to do that. It's impossible for you to do this without partnering with us or one of the other 15 approved buyers. The other benefit of the fund, before I talk about structure and fees, is our minimum. So, the minimum of 100,000, our competitors have much higher minimums, and that's back to the mission of Origin. We want to make this available to the broadest group of accredited investors that we feel need to, benefit from access to these types of investments. So just going down here, the GP, senior advisor, co-investment, that speaks again to the alignment I was talking about before. This will be our most aligned fund. We have $30 million of GP co-investment in this fund, so that's an extraordinarily high ratio. That means that that we care very, very deeply about returns. Candidly, we would anyway. And the reason this is so high is we see so much value that we want to put our own investment dollars in this risk return bucket. The first close I mentioned was in September. The final close will be a year from this past September 2022. Liquidity, we spent a lot of time on this. This is a closed-ended fund. So we wanted to make it as liquid as possible within a closed-ended structure. Closed-ended, by the way, means that there's a finite capital raising period and there's a finite life to the investment. And in this case, that life is 7 years. So you will be our investment partner should you decide to join us in this fund for 7 years. But what we've done is said, this is actually unlike real estate, where we typically are investing in the property as equity. This is a much more liquid product. Tom mentioned there's a secondary market that provides that liquidity. The IO strips are smaller investments. They're even more liquid than the larger investments, just from a size standpoint. So we feel that we can manage cash if our investment partners want to get up to 10% out per year. We're able to accommodate them, and we'll make all the efforts to do so. We believe it's possible. So if we're able to do that, that provides more liquidity than candidly any closed-ended fund that I've seen. And so if you have feedback on that, please send it to me. Tax reporting will be a K1. That's true of all of our funds. This is a partnership, so you'll get partnership K1. Because we're the fund manager and we have lots of experience, we know your pain points. People want to have them back in early March so that they can get their own taxes done by April. That won't be a problem in this fund. And then in terms of fees, before I go through our schedule, we have 4 or 5 competitors in the space. I'll mention them. Bridge is one, Kane Anderson is another, Blackstone is another. All of these competitors have higher minimums than we do, meaning higher than 100,000. And they're also priced anywhere from 10 to 35% higher in terms of promote and management fee. We wanted to make sure that not only are we a better manager, I believe we are, but we also wanted to make sure that you're getting the best possible fees in the market. And I'm sure of that. We've studied this in detail, but in terms of the annual fee, it's scaled. That's the management fee, and it's based on equity. So 1.35 from 100,000, 999. I won't read down, but I think you understand it scales from 1.35 to 0.85. For our partners who are registered investment advisor clients, if you have clients who in aggregate make it to these breaks, all of your clients get the benefit. So we have, investment advisor firms that might have 20 clients who, in aggregate are 5 million to 15 million. In that case, all of their clients would get 0.95. So that's a benefit that we can provide our investment advisory clients and partners. In terms of the performance fee, we are a 10% performance fee above a 7% preferred return. What's notable there, that's a very high preferred return for this low risk of a strategy. And when you're thinking about getting a total of 8 to 10% IRR, and we're saying we're giving you a 7 prep, that is a very, very friendly feature for investment partners. And so what we're saying there is we'll only share in the profits if we're getting at least 80% of what we promised you in current yield and return. And so that's a very interesting feature. I would welcome you, as I said before, and I named our competitors. Please double check what we've done. More information is always better, but we're pretty committed to transparency, and we know where we stand in all of these terms. Next slide, please. This is just more for our investment advisory partners, but also I should mention, because this answers one of the questions we've had, what type of capital should be invested ideally into this strategy? And the answer is capital from accounts that are tax efficient. So a tax efficient account would be if you have a foundation that doesn't pay taxes at all. If you have an IRA that defers taxes, so that helps in tax efficiency. A 401k would be another example. Some of our clients and our partners in this fund have done that with their own 401ks. And if you choose to do any of those, meaning invest money from a 401k or an IRA, you would need to have a custody arrangement. And these are the various firms we've been approved with: BNY Mellon, Pershing, Fidelity, Millennium, TD Ameritrade, Charles Schwab, Midland. It gives you an idea of how many partners we have. We have lots of investment partners in this fund already, and advisory partners. And as they come on as clients, they'll say to us, hey, but can I do my IRA? And I really want to do it through TD Ameritrade. And so we get that approved. And so as we sit today, there's just an awful lot of optionality. The reason, by the way, you want to invest through a tax efficient source, like an IRA or a foundation or a 401k, is this strategy is taxed like any other bond, right? This is a bond. All bonds are taxed at ordinary income. That's true for US Treasury bonds. It's true for corporate bonds. Any bond is taxed the same. This has the benefit of having a subsidiary REIT, which I talked about before, but nonetheless, you will be taxed at ordinary income. You'll get 20% deduction, right, because of the subsidiary REIT. If you're investing from an IRA or a 401k, you get to defer those taxes. And that's where you really ideally should be coming through. I don't have funds in a 401k that are sufficient. So I'm investing just capital and I'm getting the benefit of the subsidiary REIT, but I'm not getting that additional benefit of tax deferral. I wish I had an IRA that was large enough to do that, but I wasn't smart enough to start investing in the IRA when I was 20. If you're 20, please don't do what I did. Start putting money in an IRA. But that concludes, maybe last slide, just about more information. So if you have more questions, if you email investor relations, I know that sounds generic, but it really does go. We have, I believe, 9 people on that team. And so you'll get your question answered that day, certainly, probably within an hour or two. And they can also schedule a call to talk to you in more detail. As I said before, my information is also on the website, email and cell, so you can reach out to me. And I'll forward you to my assistant and she'll schedule something. Tom, thank you for joining. And I know we want to take questions. We're a little bit over in terms of, like, I think I said 30 minutes and it's been 50. But the live questions, I don't see any live questions. So I see that there's an awful lot of people on. If you want to send in live questions, you can. If not, we will we'll answer some of the questions that were sent in prior. So Tom, one of the questions, we'll go ahead. You're going to say something.
No, I was going to jump in with that. And one of the things that was brought up was the competitor. And you touched on the main 4 competitors that we will compete against. But one of the things that I'd like to add to that is that their funds are structured a little bit differently from ours. Our the Origin Multifamily Credit Fund is the only fund available to anybody that is homogeneous to Freddie Mac B-pieces. All the other funds have other stuff in there. So the credit fund, the Origin Multifamily Credit Fund, is multifamily bonds. All the other bonds, all the other funds that invest in Freddie Mac pieces also have hospitality and retail and preferred equity that's levered. There's a bunch of other product in those funds that are generating similar returns with higher risk profiles. And the reason those returns are often similar is because their fees are a little bit higher. So they're taking additional risk with the investor's dollar, but they're giving them a similar return. I think that's a huge advantage to Origin's fund. You know what you're going to get. It's Freddie Mac B-pieces. We walked through the target allocation, and we feel very confident we'll be able to deliver those returns with that risk profile.
So I just got a couple live questions. Thanks, Tom. Thanks for your question, Chris. His question is, how does the annual asset management fee factor into the preferred return calculation? The answer to that question, Chris, is when you're computing preferred return, it's based on your equity over time. So like, for example, if you invested $1 million, your account is accruing a $70,000 a year preferred return, meaning we have to pay you $70,000 on your money before we can take any incentive fees. And that's at the gross basis. So it's separate from what we're talking about from net returns. If you have more questions on that, please reach out to me and we can talk about it in more detail. Do you want to take Paul's question, Tom?
Sure. Advantages and disadvantages of investing with a self-directed IRA. The advantages Dave touched on, you don't have to pay taxes. Is if you are in the top tax bracket, you're paying 39% of the 6 to 8% net yield to Uncle Sam. By investing through an IRA, you're not paying those taxes, and you get to defer those for the long run. And so it's actually highly, highly accretive to be able to invest through a self-directed IRA. And again, those intermediaries who are shown on the second to last slide have all approved Origin, and you can invest if you're with Fidelity or TD or Charles Schwab or whomever. You can reach out to your representative there and say, I'd like to invest in the Origin Multifamily Credit Fund, and they'll be able to set you up.
So an anonymous question is, you talked about the upside of investing with Origin in this fund, in the sense that we're providing the same access at a lower investment fee level. Tom just brought up another benefit. It's homogenous to K-series. We're not throwing in structured loans on other asset classes. And by the way, there's a reason our competitors do that. It's because their funds are so large that if you have a multi-billion-dollar fund, you're only getting 300, 400, 500 million of this product. So you need to have other products to complete your investment parameter size. But the downside, he was asking, or he or she, what's the downside of our fund? I honestly don't know of one. I really say that in all honesty. We are a proven manager. We're a top 2% manager worldwide in real estate. We have lots of clients. We've proven that we can have clients. The clients we have tend to reinvest, and I think they value the partnership with us. And our fees are lower. And at the end of the day, we're buying bonds from Freddie Mac just like our competitors are. We have a little bit of negotiating power with Freddie Mac, but not a lot. So like, I'll take you through an example. If K96, the bond we did, if we had said to Freddie, hey, we did the underwriting on all these loans, and we do. And we actually decided out of the 50 loans, we only want 3. And you have to take the other 47 back. That would never happen. Freddie would say, no, I'm sorry, that's not how it works. You're our partner, you need to take the loans. We do have some wiggle room. We can say we don't like these 2 loans. But by the way, Blackstone doesn't have wiggle room either. So in other words, you're doing what you can, but it's on the margin. And what we try to do is focus on senior housing, student housing, those loans, or the largest loans, or the loans with the highest LTCs, or anything that in our analysis draws a red flag. And we'll negotiate with Freddie on that. But unlike our other funds, where I would tell you we we create a tremendous amount of alpha in the acquisition process. We find better deals, we find off-market deals, we execute at a higher level, all these things. Here, the real alpha is being able to have enough manpower. We have 8 analysts, we can flex, because all this work comes in bunches. So when you get a loan a bond to underwrite, you have 2 to 3 weeks to get as much information as you can on 50 loans, and that's a tremendous amount of work. And then you might not get another bond for 3 months, but we have enough flexibility in our human capital at Origin to do that. So I think the real edge here is access. And it's taken us a long time to get the access, but we have the same access as our competitors. We're just providing it to you at a better rate. So if you want exposure here and homogeneous exposure, this is the place to get it.
I'll answer the next question, Dave, and then I'm going to pass it back to you to answer both UBIT and foreign investor questions. I think those can be answered at the same time. But I'll answer Ron's question first about the underlying collateral rates relative to the rates that we're generating in this fund, and is the fund levered? And the answer to that is really a two-part question. The first is the rates and the underlying collateral for a fixed rate bond, for example, are between 2.5% and 3% today. So as a borrower of that product, I'm borrowing at 2.5%, maybe 3% fixed rate for the next 10 years. Now, what I mentioned at the very beginning is in a fixed rate bond, only about 5% of the total bond is at 8%. So the first 95% of the bond is at 1.5 to 1.75, and the total collateral is 2.5 to 3. So you've got a huge disparity between where 95% of the returns are going to the A tranche, and the remainder of it basically goes to the B piece. So there's some other tranches in between and IO strips and that sort of stuff, but the vast majority of the yield from the underlying collateral goes to the B piece. And that's the way it should be, because the B piece is the one taking the risk on the first loss position. So mathematically, it's just a weighted average cost of capital. The vast majority of that 2.5 to 3% underlying loan interest goes to pay the B piece. The second part of the question is, if it is levered, how much leverage? Now, the bond itself is not levered. However, Origin is levering our investments between 30 and 40% of the collateral. So if we take on a $10 million bond or investment, we'll put about $4 million of leverage on. So extremely low leverage relative to a lot of the other investments. So Dave, I'll pass it back to you.
Thanks, Tom. Okay, so before I jump into, I got a question about depreciation. So thank you. I believe Ang is the pronunciation. Thank you for the question. There is no depreciation in this at all because we're not the equity, we're the debt. And so that's not a benefit you get from this debt investment. Therefore, the subsidiary REIT is very important because you don't have depreciation to offset income like you do in your other real estate investments. If you're more interested in equity investments you can depreciate, that would be our Income Plus fund or our Qualified Opportunity Zone fund, because once built, those developments can be depreciated. Paul, and then I'll hand it back to you. Oh, actually, you know what? There's another question by Ang. Thank you. Can foreigners, not U.S. citizens, invest in the fund? The answer is yes. We already have family offices from overseas who are investing in the fund, and we've set up a subsidiary vehicle for that. So it's quite easy at this point to join that group. Just to get in the weeds a little bit, foreign investment is not taxed at the U.S. level. There's no U.S. withholding. And because of that reason, we do not want foreign investment money, or more importantly, foreign investors do not want the income to flow through the REIT, because when it does, it actually becomes taxable for a foreign investor. So we've structured it in a way that doesn't happen. And then the investment reverts back to the tax rate of the foreign sovereign. So for example, most of the countries in the Middle East don't have income tax. So if you're if you're a Middle Eastern investor in this, you actually don't pay tax at all on this investment. The US doesn't withhold, and then it would reverse to your sovereign. All right, Tom, you're up, and then I'll answer the question about the shovel.
Well, you have to answer UBIT first too. I'm going to check off the box real quick on the 1031 money. No, 1031 money exchange is not going to benefit from the taxes here. Again, this is a credit product, not an equity real estate product. And the second piece that I'd like to leave with is brought by Michael. I appreciate the question. Yes, there is a QSIP to invest with Fidelity, Charles Schwab, whomever. If you have interest in investing via that manner, please reach out to our investor relations, Dave or myself, and we can get you the QSIP depending on which intermediary you are using. We can get that QSIP for you, and you can direct them as to which account you want to invest in.
So I don't see the question on UBTI, but I'll answer it. I apologize. Who asked it? What was the name of the?
That was one from the pre. I saw it.
Oh, okay, I get it. UBTI is blocked via the REIT structure, so it really isn't an issue if you're not a foreign investor. It should be blocked via the REIT structure. Another question, since I'm on, Lance had a follow-up question on leverage. The source of leverage, Lance, is either bank debt. So for example, with K96, we use bank debt. That's 5-year debt at 3%. So in that case, it's fixed. It is not, there's not a tremendous amount of bank lenders who lend to this. The more customary debt is repo lines. And so we have a repo line with JP Morgan. And so those repo lines are quite liquid. And if you want to talk about that in more detail, we can. But we were using such low leverage, much lower than our competitors. I mean, Tom and I's belief with this is we're trying to create a structure that's you can view it as a cash substitute. And what we see here is no one knows the future, but the last 27 years, there's been, the worst this has been is 7% return, right? That was the 06 bonds vintage that Tom was talking about. And most of it was higher than that. But the way, and that's unlevered, by the way. The way you make really safe strategies risky is you put a lot of leverage on them. And we're not going to do that. So that's why we're using such low leverage. And because we are, it opens up the universe of lenders quite a bit. If you want to talk more about it, please contact me. Tom, the last question is shovel. Do you want to handle that? I think you know where the shovel's from. It's Chambly.
I was shoveling dirt with that shovel about, I guess it was 8 or 9 years ago now. It's from a development deal that we built and sold and was very successful in Atlanta, in Chambly. It's the groundbreaking shovel from the Olmsted, which was a great Fund 2 asset.
Fund 2 asset. And yeah, I have it because but at the end of the day, we're a real estate firm. We talk a lot about finance, and here we've gotten in the weeds of credit. But remember, this is all collateralized by rental apartment buildings, multifamily, and that is our competitive advantage, in my opinion, against anybody. We know the collateral better than anybody. We understand how to operate multifamily better than anybody. We roll up our sleeves and do it. That helps in our underwriting, but also in our operations. In the event we had to take over a loan, we know how to do that, and we've done it. Well, thank you so much for your time. Really appreciate it, Tom. Thanks for joining us. It was almost live in the studio.
My pleasure. Thanks for having me, Dave.
I noticed there was a lot of our team members walking by because you're in our conference room, so it was interesting. But if you have any questions, I'll just end with this. If we weren't clear in any way, that's not on you, that's on us. And we're willing to take more time to continue to explain this. This is an unbelievable opportunity to invest in an extraordinarily safe product that will give you yield monthly. And that's why I'm so interested in it. I think the more research you do, the more your eyes will open that this is pretty unique. Thank you for your time, and we'll look forward to talking to you soon.